Thank you very much, Philip, and thanks to the organizers for inviting me. It's a big honor to be here and a huge pleasure to be part of such an interesting program. I'm going to be presenting joint work with a colleague of mine, Agatha Bocconi, and a former student, René Kallestrup, who earned his PhD and is now making real money using these ideas, of course. We're going to be talking about financial sector linkages and bank and sovereign credit spreads. And as we've seen already in the talks earlier today, there is, of course, a huge focus on sovereign risk and on the contribution of bank risk to sovereign risk. And, of course, the interlinkages or the spillovers in the banking system is a key concern. So what we're doing in this paper is looking at, first, bank credit risk as measured through bank CDS, and show that the international exposures of banks is actually something that is reflected in a fairly detailed way through CDS credit spreads. We also then look at how this spills into sovereign risk, both through guarantees to the both through implicit and explicit guarantees to the banking system. And we have various ways of measuring these guarantees or the riskiness of these guarantees that I will come back to. So it is on the one hand side a story of bank and sovereign risk interconnectedness, but I guess it is also a story on information discovery through CDS markets. These much blamed CDS markets, that there actually seems to be a very careful tracking of the exposure patterns of banks taking place in CDS markets. So just to sort of give you the main insights in 3 bullets, the sort of takeaway at a qualitative level, you could say that the composition of the bank's asset side, the foreign holdings on their asset side, influences the CDS premia on these banks. Second, it is that the bank risk that we measure is transferred to sovereign risk through explicit and implicit guarantees. And therefore, actually, when you measure sovereign risk, in addition to common factors that have been identified in the literature, there is actually also a component that arises from the exposures of the domestic banking system to other countries. This exposure of the domestic banking system is reflected in the spreads of the sovereign to which the bank belongs. That's sort of the takeaway. Okay, there's an enormous literature on sovereign debt, and I've already been cut a little bit in my time, which is fine. But I will simply not do any careful literature review at all. There are these 3 papers that are the most closely related to what we do. The paper by De Vries, De Lahy, and Penjes uses the banking statistics that we also use, but for a different purpose, trying to simulate riskiness in the system, how defaults may spread and have contagion effects in the system. Longstep, Pan, Peters, and Singleton is a sovereign risk paper identifying a common factor. We're contributing to that sovereign risk empirics by saying, look, we also need to take into account the guarantees issued to banking systems. That will help us explain better movements and co-movements in sovereign spreads. And finally, there's an Acharya, Drexler, and Schnabel paper that looks at the feedback effects between the fact that banks hold government debt, so that when the government decreases its credit quality, it reflects poorly on the banks whose assets deteriorate. That in turn makes the guarantee more expensive for the banks. But I will leave it at that in the interest of time. So here's the basic. I'm going to spend some time explaining the very, you could say, core statistic that we're using, which is a key driver of the result in our paper. We're using these so-called Bank for International Settlement consolidated banking statistics that show aggregate exposures of one country's banking system to other countries through different channels. So if we take, for example, the case of the Austrian banking system, which I will show you a picture related to that system, and we look at, say, the exposure to Hungary, we know what the aggregate holdings are of the Austrian banking system of Hungarian government bonds, their exposures to Hungarian banks, to other banks in Hungary, and their exposure to what you could call citizens, non-financial corporations of Hungary. So basically, you know how the aggregate Austrian banking system is exposed to Hungary through these three channels: government bonds, loans to other banks, and loans to corporations and citizens in Hungary. And of course, we don't have that only for Hungary, we have it for all the countries to which Austria is exposed. And that's actually going to be a main driver. And I'm going to walk you through an example of Austria, because if you understand this example, you know how we're constructing our statistic, which drives so many of the results in this paper. So I'll do a fairly careful explanation of the case of Austria. So basically, at the end of the fourth quarter 2010, the total exposure of the Austrian banking system, according to this BIS statistic, was $468 billion. That's the figure on the bottom here. That was their total foreign exposure. Now you can decompose that exposure into a number of countries here, and we have ordered it by the size of that exposure, actually ordered by the average exposure throughout our sample period, running from 2004 to 2011. So the biggest average exposure was to Germany. In the fourth quarter of 2010, that exposure was 48.2 billion, which is roughly 10% of the total exposure. And so forth. We walk down here, the Czech Republic, there was an average of 34.8, but there was a spike, you could say, in the fourth quarter of 2010. At least the exposure there was higher than the average, and at the end of the the fourth quarter, it was roughly 13% of total exposure. Okay, so this is basically the size of these exposures. We cut it off when we reach an accumulated exposure of 85%. When we've surpassed 85%, we stop counting countries. So we're not counting, because the list would go on and we wouldn't be able to find good statistics on the riskiness of these countries, something I'll return to in a second. But if you have a very, very small country, we will not capture it down here. We are hoping to capture the main drivers by just focusing on the top 85% cumulative exposure. So we have the sizes now of the exposures, both in absolute terms and in relative terms. It's the relative term that you should now focus on. We then have riskiness, also in a very coarse manner, of the exposures to that country. And you can discuss how you would measure that. We try different things. In our first approach, we use bank CDS statistics to measure the riskiness of the exposures in different countries, whenever available. If those are not available for more emerging markets type countries, we use a sovereign risk measure that we can get also through sovereign CDS. And the basic idea is then to weigh the size of the exposure with the riskiness of the exposure as measured by these CDS spreads. So for example, in the end of the fourth quarter, the average spread of the two largest German banks was 126 basis points, the average CDS spread. And when we multiply that with 0.10, we get 13. And then basically, if you're an Excel person, what we're doing here is a sum product of this column here with this column here, giving us a sort of risk-weighted CDS spread of 163 basis points. You could argue that you should scale it up by 1 divided by 0.86, but that's a minor detail. Basically, the scale doesn't really matter too much. But it is this 163 number, which is the time series of that and the version of that computed for different countries, which is the main driver in our results. Okay, so hold on a second. So basically the idea is, of course, that this number, 163, fluctuates if CDS spreads move, or if there are movements in the composition of the balance sheet moving exposures towards more risky countries. So those are the two sources of variation in that number. If we look at the case of Austria, of course, presenting you with the prettiest picture that we can find probably in the entire sample, but just to make the case, or one of those cases that from which our curiosity arose, here's the case of Austria. So the 163 number that I just went through is that top of the red mountain right there where I'm pointing right now. And if I had done a time series of the computation that I just did, you would follow the top of the red mountain and it would give you that number. And for sort of just for interest we have, and for your geography training, we have decomposed into various regions. You know, just knowing which countries Austria borders on can be an interesting geography exercise. No, but there has been a lot of exposure in Eastern Europe from the Austrian banking system, and we've divided into non-neighboring countries and neighboring countries, and you can see the list here, and other countries. But you can see that there is an expansion here, for example, in the non-neighboring countries taking place in this period here, around 2009. So what we're hoping to be able to explain is the riskiness of the Austrian banking system as measured by the average CDS spread of the two largest Austrian banks. So the black line is the average CDS spread of the two largest Austrian banks. There need not be any, I mean, the scale isn't that important. The importance is that they track each other closely. Basically, that we can understand the riskiness of the Austrian banking system by looking at this exposure measure that I just explained. So that's the basic idea that drives a lot of this. Now, of course, the immediate criticism is, well, if there's a big common factor driving bank CDS spreads and sovereign CDS spreads, that'll be both on the left and the right-hand side, and there's no wonder that these things are tracking each other. So we need to be able to convince you that the movements we see in this average CDS spread of each country, the changes in the average of the CDS spreads of the two largest banks for country K at time T, is explained by this measure that I just explained after having controlled for local and global variables that affect CDS spreads simultaneously. So the exercise is really to try to convince you that these balance sheet effects, this composition of the asset side, really contributes after you have controlled for common factors in CDS spreads. And that's what a lot of the exercise is all about in the regression. So basically we try to run a regression where we look at changes in the bank CDS spreads for each country. It's a panel regression, and checking whether our measure, this 163 number, the time series, and of course the cross-sectional version of that, is helpful in explaining these movements after controlling for these variables. Now, lots of variables we need to control for, very little time to go through each of them. A lot of it is, of course, dictated by the variables that other empirical studies have found relevant in explaining sovereign credit risk and bank credit risk, and there's a whole list here. I will come back to these so-called expected default frequencies in a second, but broadly speaking, they are probability of default measures extracted from equity and balance sheet information of companies. Yeah, I'm not going to have time to walk through all these, but some are variables that are particular to the country in which we're looking, such as the default probabilities of firms in these countries. We have obtained EDFs, expected default frequencies, for all rated firms in all of the countries that are in our sample. So we have a very extensive data set on the probability of default as measured by this measure of companies in each country. And we could even divide it into sectors, which I'll also, which is mentioned here. We can separate out real estate and real estate investment firms, which turns out to be very important, and look at other corporations and non-financial corporations. So these are the local variables, but we also have a lot of variables that have been identified as important in other studies. So basically, to make sure that we really correct for common movements in CDS spreads, we also use 3 so-called Eyetracks indices, which are really average CDS spreads for different sectors. We have a sovereign, an average spread for 15 sovereigns, I believe it is. We have the Eyetracks index for non-financials, 125 names. So we have, and we have one for financials that sort of look at general movements of CDS spreads in these sectors. And you can see the familiar pattern of what sort of starts out as a crisis in the non-financial sector, spreads to the financial institutions, and eventually also becomes a sovereign problem. But these are 3 CDS indices that certainly contain a lot of common factor movements in CDS spreads. We include those in the regression as well. And what we find is that our changes in our measure, changes in this number that I computed before, once you've controlled for all these things, is helpful in explaining movements in average bank CDS spread. So the first column is one where I leave out these indices and after correcting for these common factors, I still get significance. Correcting with these CDS movements as captured by these 3 indices, I still get significance. We also do one regression where we say, okay, let's take the movement in our riskiness measure, the 163 number that I computed. Let's look at the changes in this number. And let's take the residual of a regression of the left-hand side on this number and see if that is helpful in explaining our movements. And we find that even the residual from this regression helps explain movements in bank CDS spreads. So that's the sort of first main results. There are a number of other variables and things I could comment on, but I'll leave that for you to peruse or to check in the paper. We have to do, of course, a number of robustness checks here to see if this result holds up. And here's a list of what we try to do. We try to do a time-fixed effect regression where we retain the EDF variables but leave out all the global variables, trying to say we may not have captured the global factors correctly. Let's do a time-fixed effect regression instead. Our results hold up. Then you could say, well, maybe is it really important the detail to which we model this exposure measure? I mean, I'm not arguing perhaps that the exposure down between 81 and 85% is the key determinant of the riskiness of the Austrian banking system, say. But it is the case that if for all countries we leave out, for example, the 5 biggest exposures, and look at whether our measure would then be successful, then we do not get significance. So there is clearly an extent to which the market is tracking the particular exposures and not just some common factor that we haven't been successful in capturing. We also try one where we use sovereign CDS measures throughout our regression instead of having both bank and sovereigns in there. We split into the very exposed and the less exposed, and we leave the US out, and we still find significance of our results. Now, you could say that it's too narrow to focus on the foreign assets. Of course, banks have huge holdings of domestic assets as well, including domestic government bonds as well. Here's the case of Austria again, just to stick to an example. Here's the 468 that we saw before. Here's the total balance sheet of the Austrian banking system at the end of the fourth quarter, 2010. And here how it is decomposed. Here is how it is decomposed into bank holdings of Austrian government debt and lending to Austrian corporations, say. And this allows us to construct another course measure with the hope of capturing other places. And this was constructed even before I knew Xavier would be here on the panel, but this is the case of Spain, where you can see that our measure fails to capture the spike in the bank CDS spread that you see over the last couple of years here, and where there's clearly a very important domestic exposure of the banking system in Spain that we need to capture, for example, through real estate. So if we modify our number using these EDFs, which are default probabilities for firms, and construct, let me actually be a little quick on that and say, here's what we do. We take the changes in bank credit risk. This is my measure that I computed before, the 163 for Austria in a particular quarter. Now I'm weighing it by how large the 468 divided by the total assets, that were just above 1,000. So basically taking into account how big is the foreign asset exposure compared to the total balance sheet. That's what this weight is doing. How much government bonds are they owning out of their total balance sheets? Weighing that with the sovereign credit risk spread. And finally, how much domestic credit is there to retail customers and corporations? And using here actually the real estate EDF, but we're working with two versions now. One where we also just use a median of all EDFs that we have access to for the particular economy. A coarse measure, but the idea is, of course, to get a sort of risk measure that covers all banks, all the activities of the banks. I realize still in a coarse fashion. Now, if you do this, then what you see for actually, let me skip this. What you see if you try to compute our riskiness measure is that we still track Austria fairly well. The CDS spread is now the red dotted line. That's the riskiness of the Austrian system. Here's the riskiness of the Spanish system. And the blue line is our extended measure that takes the domestic exposures into account. And that is more successful in tracking both Austria and Spain. And throughout the entire sample, that measure turns out to be extremely powerful, both in the full sample covering before crisis and after crisis, and even if we divide into subsamples before and after the onset of the financial crisis. So that's the second measure. How am I doing on time, Philip? 2 minutes. We then finally do a sovereign CDS analysis in which we try to say what was the effect of the explicit guarantee that was made on a lot of European banks in September 2008, following the Irish guarantee, just after, in the wake of Lehman. And we also try to measure the importance of an implicit guarantee, which we simply proxy by looking at the size of the banking system compared to the GDP of the country, arguing that the larger the banking system is, the more critical is the implicit guarantee. But we have a dummy variable for the explicit guarantee and a time series variable for the implicit guarantee. And control for a number of variables that you can check in the paper, including variables that traditionally explain sovereign debt measures that help explain sovereign risk. And we find that the guarantees are important in explaining, but the explicit guarantees are important in explaining sovereign credit risk, and the size of the banking system compared to GDP is important in explaining movements in the sovereign CDS spreads. So basically our two ways of trying to measure the guarantees of the banking system are reflected in sovereign CDS spreads, unsurprisingly, you could say. Finally, we then ask the question, and that's going to be my last point, is it the case then that if you took our measure of bank asset holdings, this 163 number that I looked upon, is it the case that you can actually directly measure the influence of that number in the sovereign credit spreads? So if you put that variable in to a regression that explains sovereign, so you don't just make the logical argument that foreign asset holdings affect banks and banks affect sovereigns, but you try directly to measure whether foreign asset holdings in a regression will affect the sovereign credit spreads. That turns out to be the case. And again, without going into detail, you will have to check the paper, which is being updated as we speak. It turns out to be the case that the sovereign credit spread movements are explained by the bank foreign asset holdings of the country whose sovereign spreads we're looking at. And with that, I'm going to conclude basically that the CDS spreads for banks reflect financial linkages, you could call it. So perhaps it's not really, it's not a contagion story, it's more like a balance sheet story basically, that what they have on their balance sheet affects their risk. I've presented two measures, one that looks at foreign exposures and one that just that looks at the entire asset side, and both are highly significant. And the guarantees of the sovereign of the banking system is an important explanatory variable for understanding sovereign CDS spreads. And you can even measure that, the importance of the foreign asset holdings of banks directly on the sovereign CDS risk. And with that, I will conclude.